Welcome back to the Short Vol Live show. My name is David Lincoln, and I have a special guest today, Lance Roberts. And welcome to the show, Lance.
Hey, happy to be here. Thank you so much for having me.
Well, I'm excited because I found your website while I was searching around the net the other day, and I wanted to bring it to my viewers' attention because you have some excellent information on there. It was interesting when I reached out to you. You were telling me that you have a ton of experience in this industry as far as broadcast.
Right.
So that's something of interest to me because I'm a total rookie. So maybe I can learn a tip or two from you today.
Yeah, no problem.
So I apologize, first of all, that this is an off day. I didn't quite realize when we were booking this that the markets would be closed today for to celebrate George Bush's life. Did they announce that really recently or something?
Yeah, that was actually last week. And this is something this isn't a new thing, right? This has been done previously in the past that when a president has passed away, they will actually close the stock market and the bond market for a day of mourning, so to speak. So that is today. This was announced last week. Donald Trump, when we found out about the passage of George Bush, of course, H.W. Bush, the father, then he announced that they would be closing the markets today to celebrate that passage.
I have a small connection to the Bush family. My father worked with his brother, and my dad posted something online last week where he was talking about when his brother announced that Bush would be running for president initially, and my dad was at this meeting when that happened. So I have a small connection to the whole thing.
Yeah.
Yeah. It's kind of strange these days when there's a day off of the markets because there's kind of a lot of stuff open now. It seems like every time there's a holiday, more and more futures are trading.
Yeah, well, and look, things have changed in recent years, and now that we've become much more globally connected in terms of not only just the ability to trade internationally, trade 24/7 in a lot of cases. We've opened up the market dynamics to a whole lot more influences, but then also just the speed of information flow has dramatically increased. I've been managing money since 1987, and I've seen tremendous changes during that time in how we approach markets and how we approach investing. And what used to be a process where investors truly invested money for a longer term outlook, a company would announce earnings. 3 days later, you'd find out about what those earnings were. By the time it went to the brokerage firms and it made it to the Wall Street Journal, it was a day or two later. And so you didn't have these big knee-jerk reactions on the announcement that there was a miss of a penny on somebody's earnings. And so things were a little bit different. They moved slower. And you could truly invest based upon a company's fundamentals and outlook and those type of things. Today, because of the speed flow of information and how we react to things, we've turned Wall Street from an ability to invest into basically just a big giant casino where we all just, kind of flip trade things as fast as possible.
Yeah, exactly. I remember it must have been like around, I don't know what it was, maybe 92 or 93 when like analysts all of a sudden had to be more accountable. Like before then, analysts were always recommending everything. And there was kind of a little bit of a change at that point where like it became slightly more realistic. They weren't, recommending everything. And there wasn't so many like of those sort of pump and dump scandals with analysts. It's gotten a little bit more realistic.
Well, that lasted until right after 1999. And of course, you remember Henry Blodgett, of course, he's the head of Business Insider now. He was banned from working in the financial industry because of his recommendations on .com stocks and NASDAQ stocks going into the 2000 .com bust. But there was a recent survey out, and I've written articles on this on our website called The House of Cards, which they surveyed sell-side analysts across Wall Street. And where the value of their research goes to the actual individual investor. In other words, do you make a recommendation for the benefit of the individual investor? That's at the very bottom of the list in every single case. At the top of the list is their institutions, pension funds, mutual funds, things that the big buyers of assets. Those are the ones that they cater to the most. And kind of the retail investors kind of still left at the bottom.
Yeah, I mean, my background is I was a market maker on the floor of the CBOE for many years, professional options market maker,
Yeah.
and we basically had no confidence in analysts, and we thought they were just, all just representing their firm. If
Sure.
they were recommending something because they wanted to. I mean, we had a very skeptical view of things, but I wanted to give you a chance today to be kind of on the other side of the mic just for a second. I know you run a show almost every day and you're always interviewing other people. I wanted to give you actually a chance to talk about yourself for a second for a
Sure.
change.
Sure.
So can you give me just a little background into how you got into this business? Were you into stocks and bonds and that sort of thing as a child, or did it start later in life for you?
It was a little bit later in life. When I was growing up, this was back in the 60s and the 70s. A lot of people weren't actively involved in the financial markets. In fact, when I was growing up, there was a guy that lived about 5 houses down from me. And he had a stockbroker, and this was like one of those rare things that people whispered about at parties. Oh, he's got a stockbroker, because most people didn't actually participate in the financial markets. It was, kind of a few individuals that invested in stocks, and again, very long-term holding periods, et cetera. And of course, in 1974, during that bear market crash, it wiped out most investors, and a lot of people left the markets and simply didn't come back after that until really the mid 80s, which after I graduated college in 87, I went to work for a bank, managing a book of business there. And our bank was bought by another bank. We were closed down. So I wound up going overseas to work with some international bankers that I had relationships with, and spent about 8 years living in multiple countries overseas, managing high net worth individual money, real estate deals, et cetera. Came back in the 90s, opened up a broker dealer here, because what I saw and what I learned from working internationally and coming back is exactly kind of what you and I were just talking about a minute ago, is that the individual investor is really taught a lot of very bad things by Wall Street in the advent of trying to sell product. And what retail investors need to understand is where they stand in in kind of the line of value for Wall Street. When you hire a real estate agent to sell a house for you, you have a pretty clear understanding. They're going to sell your house. You're going to pay them a 3% or 6% commission to sell the house. And that's the deal. You know that going in. Wall Street has positioned themselves as, hey, we're here to help you grow rich, and we're going to charge you a small fee for doing that. But we're here to help you grow rich. But the reality is that Wall Street uses a lot of retail investors to offload product, sell product to, and Wall Street is a sales and marketing machine. That's what they do. They create product, they sell it. That's how they make money. And as long as you have an understanding of that going in, you have a much better propensity to manage your money better than expecting them to take care of you, because that's not really what they're structured for. So when I came back in the late 90s, opened up a broker dealer, and then transitioned over to a fee-only advisory business in early 2000, was this idea of bringing institutional-style risk management, actually managing risk, creating returns that are risk-adjusted over time, and bringing that to the retail investor, because it's the one thing that they're not told. They're told to buy and hold stuff. They're told to dollar cost average. Don't worry about the ups and downs. But people with money don't actually manage money that way. So we came back to really build that, and that's what's become ultimately Real Investment Advice and RIA Advisors.
So, which countries were you in when you were overseas?
I lived in Spain for a while, France, and actually worked out of a bank called Monte Paschi Bank. It was in the headlines a couple of years ago, but actually worked from Monte Paschi Bank, managing money in Monaco. So.
Oh, that's interesting.
Yeah.
Monaco, huh? Wow. Yeah, that's definitely a good spot to find high net worth individuals.
Yeah, absolutely.
I lived in Italy for 7 years when I was younger, and I got to go to Monte Carlo a couple of times. So what would you say on your website? So you've kind of shifted from, I'd say, a smaller group of high net worth individuals to more of a middle of the road type clients. What's the average person that's on your website, would you say?
Yeah, that's actually a great point. Is that when I was overseas, working with individuals, we were working with a lot of French citizens who did not want to keep money inside of France because of basically by the time you add in their VAT tax and everything else, you're talking about an 80% tax rate. So they wanted to keep all their money offshore. Well, the U.S. was offshore for French citizens. So we were actually managing money through Merrill Lynch in the U.S. for French citizens. And so that was one of the reasons that brought me back to the U.S. was that, Merrill Lynch wasn't really doing what I needed them to do, because very high net worth individuals, they go, I have two premises and two basic instructions. A, don't lose my money. B, make me some money that at least grows at the rate of inflation. They're not worried about trying to beat some random benchmark index, trying to beat an S&P 500. They don't want to lose their money because they've worked too hard to make it. And B, they just need it to grow at the rate of inflation. And so when we came back to the States and I left that firm to start my own firm, the reason for that is that in 99, I started writing articles about the coming crash and expressing to individuals like, you need to be very aware this crash is coming. These valuations cannot persist. And from a function of risk, you need to be aware of this. And of course, nobody believed me at the time. And of course, what happened next. Well, when I was at that time, I fell kind of back asswards into doing a radio show on this little station here in town. And in fact, my producer here, Brent Clanton, was the operations manager there that actually hired me to do this show. I don't know why he did it at the time, but that's a story for another day. But we were talking about this coming crash and what was going to happen. And then one day, the crash was occurring. And I said, look, here's the thing. If you need help, here's my office. Bring your statements. Let me take a look at what you're doing, and I'll help you out. Right. And the next morning I get to my office, there's a line of people outside of our building. We're like literally ordering pizzas and putting people in a conference room 10 and 20 at a time to look at their financial statements. And every one of their statements, I mean, people didn't matter if they were 50 years old or 70 years old. They were all, 50.com stocks, right? There was no General Electric or no Procter & Gamble. It was all .com stocks, no matter what age they were. And that was the moment where I left that firm and I started my own firm to work with individuals. And this is still our focus today. People that really range between about $750,000 to about $4 to $5 million in asset size. And the reason that's a sweet spot for us is that it's a level that's ignored by the Goldman Sachs of the world. They're too small for their institutional side. They don't want them. They're too small. But they don't get the attention they need. I get, people come over with $3 or $4 million and they're all in mutual funds, or they're all in just a basket of ETFs that are all linked to the stock market. So they're not getting the advice they need to preserve and grow their wealth over time. And so that's where we've really focused and honed our business.
Oh, that's fascinating. That's really fascinating. It's funny when you were talking about the .com era, and I was definitely I traded through that. I think we probably both were under the umbrella of Merrill Lynch together at some point in the past, because I was clearing Merrill Lynch from 94 through 2000 about. So we were probably working for Merrill Lynch at some point together.
Absolutely.
Yeah, when you talk about that .com, everybody having .com, it really does remind me of the cryptos. People saying, I've got Bitcoin, but I've diversified. I've got all these other altcoins. So I have a diversified portfolio. And, it may sound ridiculous to you or I, but for people who had never traded before, knew nothing about investing, and this was their first entrance into any sort of trading world by buying a Bitcoin, making some money on it, and then having to do something with that money, it sounds very similar to the .com era.
Yeah, it's interesting. The worst thing that can happen to any investor, and I am a strong believer in this, the worst thing that can happen to an investor is to be successful the first time they invest. Because they get this air of overconfidence that, man, I know what the heck I'm doing. And so they make some money with Bitcoin and go, well, that worked great. Let's do it, 10 more times. And we saw the same thing with .com stocks. Look, I was in the middle of the .com era. I'd go to work at 8 o'clock in the morning. I'd buy SDLI, and this is 1999. I'd buy SDLI at the open. I'd make 50 to 80 points on it by the time that the market actually opened up by 8:45. I'd sell the position, go home for the rest of the day. I didn't need to do anything else, right? And don't forget, in December of 2007, I wrote an article that said that we were about to be in, or already were in, the worst recession since the Great Depression. It wasn't until a year later that we figured out that we were. But you saw the exact same thing occurring in 2007, 2008 with flipping houses. And, you know, I was watching HGTV with my wife one day, and it was like one flipping show after another. And, you know, I told my wife then, I said, this housing market's about to crash, and it's going to crash big, because when you have this many shows flipping houses, you know that you're at the peak of a cycle. And of course, it was a year later, the whole thing came apart. You're seeing the exact same thing again today. You have the same type of flipping shows on television, but this time it's not just real estate, it's the stock market, it's real estate, it's corporate debt. The risk to this market this time around is you've got a bubble in multiple assets because of what the Fed's been doing with suppressing interest rates and artificial interventions for the last decade. So the next crisis is going to be really bad. I just don't know exactly when it's going to be.
So do you, so I remember, what I remember from like that era, like 2000, 2001, was us just grinding lower every day. Well, first of all the business dried up in options paper where I was standing in the pit, but it just seemed like a slow grind lower for months and months, which was new to me at the time. And I'm sure you talk about it like a lot of us do, that there's a generation of investors who have never really seen a down market or a bear market.
Oh, yeah.
And it's going to be a shock to these people. Do you see a lot of parallels right now towards like that 2000, 2001 era?
No, you know, it's interesting. The answer to your question is yes, sort of, but it's actually more of a parallel to what we saw in 2007. Okay. And let me tell you why. In 2000, and really in the dot-com crash, the dot-com crash was really isolated to the NASDAQ. Small caps, mid caps actually did pretty well. You know, fixed income did well. You know, there was a lot of other asset classes that were performing very well, even during the 2001-2 decline, which was primarily focused on that dot-com section of the market. This market right now, and again, take a look at Deutsche Bank. Too many people are dismissing Deutsche Bank as just the one-off problem child. But don't forget that leading up into 2008, Bear Stearns blew up. Nobody paid much attention to Bear Stearns at the time, but two of their major hedge funds blew up over high yield paper. And everybody kind of wrote it off. And then when Lehman shows up, you know, 8 months later, all of a sudden it's a problem. Deutsche Bank is very much potentially that canary in the coal mine that we are potentially heading into another credit-related crisis. And the reason I say that is because you have the very catalyst in place. You had a massive surge in corporate debt. You've got roughly about 50% of a lot of your bond funds trailing in either BBB or lower rated paper. And you've got rising interest rates. And interest rates going up always cause a credit related event somewhere. You just never know where it's going to show up. And so the issue is you look at the grind of this market this year, where we were, you know, up big in January, down 10%, rallied all the way back to new highs, declined in October, November, trying to rally up here off this bottom again. That's very similar to if you want to do analog comparisons. It's very similar to kind of the topping pattern we saw in 2007 moving into 2008, which was that struggle to gain ground, but losing ground at the same time. And that's kind of what you see going on right now.
So the other day I was watching one of your podcasts, just trying to do a little research before the show. And I noticed somebody who you were interviewing make a political sort of comment. And I saw a little look in your eye as that happened. How do you handle politics with your customers? As far as, because for me as a YouTuber, I have to be very careful not to alienate people. So how do you handle that with your clients?
Well, and so let me give you some full and fair disclosure. So I've been doing radio for about 18, 19 years, but in the past 6 or 7, I was actually doing a full-time political talk show, along with a financial talk show as well. I was actually doing two radio shows on a station here in town. And the station is a conservative talk station. So obviously it leaned towards the conservative side. And again, full and fair disclosure, I am a fiscal conservative. Now, I'm not Republican and I'm not Democrat. And I just lost you, David.
Hello? Yeah, I don't. It must be a network thing. I don't know. That was weird. It just cut out.
It's because you ask a political question and cut you off.
Right, right. They're censoring us, right? They're trying to stop us.
Let's try this.
All right.
Let's try this one more time.
Okay, you ready?
Yes, go.
So I was watching one of your recent videos, and I noticed somebody was talking politics with you. How do you handle politics with your clients?
All right, full and fair disclosure, I've been doing radio for about 18, 19 years, and over the last 7 or 8, I was actually doing a full-time political talk show on a conservative talk station here in town, because as understanding how politics do affect our economy, it's important to kind of understand how those operations work. Now, full and fair disclosure, I'm a fiscal conservative. I'm not Republican and I'm not Democrat. I believe that our debt is an issue. I believe that we need to have a fiscal house in order. I believe in spending. I'm not for deficits, these type of issues. Call it crazy talk, but I believe that our country should be solvent. It's just kind of one of those issues longer term for my kids. I would like to see that. So it was interesting, though, that during the previous administration, you and I could be on opposite sides of the ledger, and we could have an open and honest discourse about political issues, whether we agreed with them or not. And we could have a discussion about what is good and what is not. Since this last election, that is no longer the case. It has become such a level of vitriol that you cannot even have an open and honest discourse about the issues that truly affect the outcome of our country longer term. And so when people ask me politics today, to your point, I kind of wince because, you never know what's coming next, right? I never know what
right.
what that next shoe to drop is. But let's be very clear about something, is that when it comes to investing money, you cannot totally dismiss politics as a part and parcel of an important outcome of what's going to affect your portfolio over time. Things like tariffs, trade wars, those are already having an impact on the economy. Now, I was talking about this back last October, saying, look, things like tax cuts, which are focused on corporate taxes only, do not help the average American. They will not help the economy long term. They'll last for about 1 year. And then once you get to year-over-year comparisons and earnings, that effect goes away. But you haven't really developed stronger economic growth for the individual. You're not going to see a big pass-through of these tax cuts to higher wages and people's wealth and prosperity being brought up across the country. But again, remember that 70% of GDP is driven by what you and I buy. So if you're not helping the U's and the I's, you're not going to get long-term sustainable economic growth. And I also said at that time, corporate tax cuts are going to go to one place only, and that's going to go to corporate share buybacks. That's exactly what's happened. And then when we started talking about trade wars, I go, this is the worst idea ever. Tariffs are a tax on the very people who didn't get any benefit from the tax cut to start with. So you're only making it more difficult on them in terms of creating economic growth. Well, here we are a year later. All this stuff is starting to come through. But, again, these political decisions, and this isn't about a right or left thing. This isn't about I like Trump or I don't like Trump. That has nothing to do with that. It's simply, do the politics that occur in Washington, do they actually benefit the economic prosperity of the country as a whole? If the answer is yes, it's a good policy. If the answer is no, it's not. And when you're running $1 trillion deficit in the middle of an economic expansion, that is not good economic policy.
Yeah, I would definitely agree with that one. So my channel is about volatility. Most of the people that watch my channel are trading, either directly trading like volatility ETFs, or they want to learn more about volatility and options trading and that sort of thing. Do you follow the VIX? I'm sure you follow the VIX.
Oh, yeah.
How much does the VIX and volatility levels come into play for you when making investment decisions with your investors?
I think it's incredibly important. It was interesting. People that were shorting the VIX learned a very valuable lesson about options and volatility in February of this year. And, that's something that, you can't not understand about volatility. Volatility comes in very, very fast terms. It's kind of like a snake. It'll lay dormant for a while and it'll reach up and bite you really quick. You know, and I'm from Texas, so we use those type of analogies. So,
Nice.
but you know, the issue is that volatility is very important. And one thing I've been noting, you know, really in October, November during that sell-off, I made several comments through our blog posts, our newsletter, and on our other podcast, saying that, you know, the one thing about this sell-off that's important is that traditional investments that should be going up during this type of decline in the market aren't. And what that tells me is that there's most likely still a high degree of complacency within the market, even though the market's selling up, because the VIX traded right around 20, kind of its longer term average. So you weren't seeing a big spike in volatility, or the VIX in particular. Bond yields were hanging up around 3.1, 3.2%. You weren't seeing a big move into safety in terms of people buying treasuries to, you know, get out of the risk of assets. And gold really didn't. It ticked up a little bit, but not anything like you would have expected if there was real fear in the market. So, you know, when you now here's the difference. Look at what happened with the sell-off yesterday. Market was down 800 points in the Dow. The 10-year Treasury fell to 2.88% in the middle of the day. It bounced up to about 2.92, but sharp decline in rates yesterday as money actually rotated into fixed income, and specifically treasuries, not corporates, not floating rate, et cetera, but it went into treasuries, which is a confirmation that people are looking for absolute safety. You know, so those are the things that we definitely look at when we're positioning assets. And more importantly, if we're going to take on more equity risk or not. Right now, we're running about 60% cash in our portfolios. We've got very little equity exposure at all. A lot of defensive positions. We've been adding to our, every time interest rates got above 3.2%, we were big buyers of longer dated bonds and treasuries as a hedge for our portfolio. So, you know, all that's working really well right now. But, you know, when you're starting to see the volatility index turn up, when you start to see yields fall rather sharply, that tells you that we may be in for a bigger correction than what a lot of people think right now.
Yeah, it felt. I was talking to a ex-Goldman Sachs guy in Singapore yesterday when about that sell-off, and it felt a little different. That there was this like a 10-minute period that was a really violent sell-off, and I still haven't been able to figure out exactly why that moment happened, but it felt pretty violent that one moment yesterday. It was definitely it felt a little different. I just want to go back to one thing that you were saying. You were saying how for that sweet spot of investors, I think you said $750,000 to $4 million, $5 million, that they were they had most of their money in mutual funds and weren't doing what you thought they should be doing. What just in the broadest terms, what should somebody be doing that has like $1 million? Like, how should they be investing their money? I mean,
well, you don't do buy and hold, okay? And look, I'm not bashing buy and, don't get me wrong, I'm not bashing buy and hold. For a lot of people that are trying to save money, right? You're just getting started, you're 30 years old, 25 years old, and you've got a long time frame ahead of you. Yeah, save and invest the money and keep contributing to it every month, and yeah, you're going to build some wealth. But if you've got $1 million, you're probably not 25 or 30 years old. You're probably closer to retirement than not by the time you've accumulated that much wealth. It's interesting. There's, people say, well, this time is different, right? And of course, whenever somebody utters that, that this time is probably not different. If we go back to 2000, I was a lot younger then than I am today.
We all were.
We all were.
Yep.
And so if you were in your 30s, but think about this for a second. You're in your 30s in 2000, right? 18 years later, the market's returned on average about 5% on average, but most of that's occurred just in the last couple of years. From 2000 to 2014, the return on the market was zero. You were spending a lot of time getting back to even after two bear markets. So the problem is that now you're no longer 30 years old with 25 years to go to retirement. You're 48. Your retirement is just around the corner, so you can't afford to take another 15, 20, 30, 40, 50% loss because you simply don't have the time to get that money back and to reach your financial goals for retirement. And this is one of it's always interesting. People talk about, well, if you just had $1 million in the bank, you could retire. Well, if you think about this, the one thing that we never tell people is that here, let's use the example again. It's 2000. I'm 30 years old, and I make $70,000 a year. So if I can get $1.5 million in retirement and I can yield out 4% on that, I'm going to make roughly about my $70,000 a year. Well, what nobody calculates is the fact that my $70,000 a year is no longer $70,000 a year 30 years later. It's $135,000 a year. It's almost double due to the rate of inflation. So the cost of living goes up, and therefore I don't need $1.5 million in the bank anymore. I need $4 million to make that number work. So what we never tell people is that riding markets up and down is great, fine, and dandy, but you're getting further and further away from your inflation-adjusted savings that you need to create the inflation-adjusted income you need to support your lifestyle. And so people with $1 million or more are generally closer to retirement than not. And they can't afford this buy and hold mentality where they lose 30 or 40% of their money and they're going to make it back at some point. They're going to get back to even. And then they're somehow magically going to have enough money for retirement. So, our sweet spot is understanding that and explaining, look, our job is simple. Protect your capital, grow it at a rate of inflation so that you maintain purchasing power parity of your money as you head into retirement. And if you do this, you're going to be okay. If you don't, you're not.
That makes a lot of sense. If I can just go outside your sweet spot for 1 second,
sure.
What would your recommendation be for somebody maybe who's listening to this program, who's a younger person who maybe is in their first job, hasn't saved anything, wants to get into the market, has heard about the stock market. Maybe they came to this country from another country and are just gotten here. How does someone get started in investing?
Okay, I get this question a lot by email.
I'm sure you do.
and it's a very difficult question because, look, let's understand one thing about the stock market is that you and I and everybody else in the world, we go to school and we go to college and we spend years in school to learn how to do whatever we're going to do. We're going to be a doctor, a lawyer, pharmacist, whatever it is. We spend years in college learning how to do that job. But yet the stock market is probably, bar none, the most complicated, the most convoluted game on the entire planet because it's economics, it's politics, it's financial information, it's all these things all tied together at one time. And yet we spend little or no time as individuals in this country or basically in the other country learning how money actually works in the markets. Our financial education in this country is extremely poor. And that's showed through statistic after statistics after statistics. So for somebody just getting started investing, this is always my advice to them. First thing is save up in a bank account in cash 3 or 4 months worth of salary. And the reason for that is that once you invest, you need to give whatever discipline you're going to use time to work. What happens with most people is they take whatever little bit of money they have, they invest it in the stock market, and then they're going to wind up with some family emergency, right? The refrigerator goes out or the car breaks down. And those things always happen at the worst possible time when the market's taking a big hit and you've got to liquidate your account to go meet that emergency. And of course, the investment wasn't working anyway, so I'm never going to do that again. And we create all sorts of bad habits. So having an emergency reserve of 3 to 4 to 5, I like 6 months personally, but have some money set aside to meet those family emergencies. And that right there alone will put you ahead of 80% of the country that can't meet a $500 emergency without tapping a credit card. So there you go. You're already moving in the right direction. But then you want to start but then you want to start investing. Sorry, I didn't mean to interrupt you.
No, go ahead. Please continue.
But then you want to start investing. Look, save up some money. You can't really invest with any success with $500. Yeah, you can go on to Robinhood and Stash and some of these other apps now, and they're great at teaching you how to gamble. But save up some money so that you have the ability to actually build and invest into a diversified portfolio, whether it's ETFs or mutual funds or individual equities. Don't really care. But be able to buy enough of a diversity within your portfolio to give yourself a little bit of risk adjustment. So, save up $5,000 or $10,000. I know this all sounds like big numbers to a lot of people, but investing is about growing savings. Investing is not about building savings. And this is the thing we get backwards when we tell people about how to get started investing. In most cases, all we're doing is teaching our youth how to gamble in the stock market, not actually how to invest and grow wealth. And again, what the stock market is there for is to grow our savings at a rate of inflation, to adjust those savings over time for inflation, not to gamble our way to wealth. Because when we start gambling, all we do is take on excessive risk. That leads to large losses. Risk is not about how much money we make. It's about how much money we lose. And when we lose enough money, we quit doing the very thing that would grow our wealth over time, which is actually investing. So save up some money so you can build a portfolio. Now, while you're building that savings up to start investing, read everything you can get your hands on. Read Ben Graham. Read securities analysis. Read books by great investors, Paul Tudor Jones, etc. Read. Understand what you're doing. Understand investment strategy. And look, this as a commodities and futures traders. You understand market movements, how things adjust, how markets respond to certain news. And you've got to understand that before you start investing money, because you've got to know not only when to buy, but also when to sell. And that second part is the most valuable part of investing, is understanding when to sell.
Excellent. Well, that gives people a little something to think about. Yeah, my advice to so many people to start with is just get yourself in a situation where you're living below your means and you're saving regularly before you start worrying about where you're going to put it. That's the huge hurdle for the majority of the country.
Yeah, and again, look, if you're saving up 6 months worth of salary, if you're saving up another 10 grand to invest, you're doing exactly what you just said. And you've got to be there. You've got to have free cash flow to invest and save.
Exactly. Well, listen, I really appreciate you spending a little time with me today. And I would say to all my viewers, you don't have to have a bunch of money to really benefit from realinvestmentadvice.com website. I've been following actually Jesse Colombo, who I believe is with you guys for a while now.
Absolutely.
He's got a great Twitter account, which I'm a fan of his. So
good.
Yeah, thanks for coming on. And I'm going to leave links in the description to Lance's show and to his website. I definitely recommend checking it out. I've gotten a lot out of it. I just discovered you a couple weeks ago. There's so many investment things out there to discover, and I'm glad I found you. And I hope we can continue this dialogue between us in the future at some point.
Love to do it anytime.